Hey, what's up, guys? Welcome to Accounting with Karim. And as always, before we start, honesty and integrity builds credibility. And for this video, we're looking at the accounting cycle. And so let's dive in. So the first step we have is a transaction, right? So that's the first step in the accounting cycle. So we need to be able to identify, analyze, and record all transactions that are related to the entity. And so the identification process is important, right? So we need to be able to identify transactions that are only related to your entity, right? So no other entity, and also need to be able to distinguish transactions between your company and you as the owner, right? Remember the economic entity assumption that the entity and the owner is separate. So activities of the entity should be kept separate and distinct from the owner, right? And then also for the transaction step, we need to be able to categorize those transactions appropriately. So the end result we're able to provide a more meaningful financial information to the users, right? The next step in the cycle is the posting. So we need to post to the GL, the general ledger, right? So posting to the GL is important. As you know, the GL is the foundation to your accounting database. This is your base, right? So if you've ever used an accounting software, you have to set up your GL before you can do any work, before you can do any transactional work. And then from posting to the GL, we have the unadjusted trial balance. And so the unadjusted trial balance is really a trial balance that, there hasn't been any reconciliation yet for that accounting period, right? And then, so this is where we have to make those adjusting entries. This is where the adjusting entries come in, where we have to say, hey, we know we have to make sure that we capture all the transactions that happened within this specific accounting period. And it doesn't matter if those transactions are paid for or not. It only matters if those transactions are happening within this specific accounting period, right? Because remember, we're using the accrual basis of accountants, not the cash basis, right? We're using the accrual basis, right? And so when we make all those adjustments, the bank reconciliation, the credit card reconciliation, the loan statement reconciliation, your AP, AR, making sure that you send your customers your invoices, um, accruing for expenses that took place. You may have a PO that you need to capture. You haven't really received the invoice yet, but you need to make sure that you capture this expense within the accounting period. So you need to make all those adjustments. Once those adjustments are made, then we have the adjusted trial balance. And from the adjusted trial balance, you can go ahead now and make and generate your financial statements. So if you have an accounting software, the this is you can generate financial statements, very quickly, very easily, but you have to make your adjustments though. That's you. And so this is happening on a monthly basis, right? So you're this is very repetitive, you're doing this again each and every month, right? And so there's an additional step in the accounting cycle that only happens once a year. So this is a one-time step, right? So it's called, closing the books, right? So to understand closing the books, we have to understand like temporary and permanent accounts, right? So temporary accounts are your income statement accounts, and permanent accounts are your balance sheet accounts, right? So your revenues, expenses, like those are temporary accounts. Assets, liabilities, equity, those are your permanent accounts. And so the reason why the income statement accounts are temporary is because they're reset every year. So at the end of each fiscal year for the next fiscal year, your income summary or your income statement accounts, they go back to zero. So The purpose of the income statement is to see how the company is performing within a specific period of time, right? That is the purpose of your income statement, to see how did we perform within this period of time. And so at the end of, if a fiscal year is like the longest accounting period, right? This is the ultimate performance measurement that we have. How do we do for the fiscal year? And so for the next fiscal year, we need to start from scratch again to see how we're doing compared to last fiscal year. So that's why we have to close out those income statement accounts and reset them and start from zero again, right? The balance sheet accounts, those are permanent. Those are not accounts that are reset and start back to zero. Those accumulate over time and they do not reset, right? So the balance sheet is at a specific period in time. So from inception to as of today, right? Income statement is within a period of time, January, December. That's it. All right. So your accounting software will definitely do this automatically. This is not something that you have to do manually, but just to show what this looks like or what it actually does, you know, revenue, we have a temporary account called the income summary account. And so we close revenue. The normal balance for revenue is a credit, so we close revenue into income summary account. So we have to debit revenue and credit income summary account. So no revenues is down to zero, right? And then we go expenses, we're closing expenses too, right? So we close expenses. A normal balance for expense is a debit. So we credit expenses and debit income summary account, right? And then so the difference for in this example, there's a net income, it's not a net loss. For this example, so revenues is more than expenses. So we still have a balance in the income summary account, which is a temporary account. And so now we have to close the income summary account into the retained earnings. And this is what we're doing here. And so now these accounts all went back to zero from expenses, revenue, and the income summary account are all zero. And then we next fiscal year we start again from zero, right? And so yeah, that is it for the accounting cycle. And one additional reconciliation that you would have to do in, for example, a merchandising company is inventory reconciliation, right? What's in the warehouse and what's on your books. In a service company, obviously you don't have inventory, so the steps will be less. All right, that is it for this video on the accounting cycle. And as always, before we wrap it up, honesty and integrity builds credibility. Until next time, I see you guys. Cheers.